Yo, what's going on, everyone? Welcome to the next lesson. This is going to be on different types of order blocks. If you guys are here right now, I would supposedly expect you guys to already finish the previous video, which was an introduction to order blocks. So this one is just going to be the different types of order blocks and all the different types of setups you'll see order blocks in. So like I said in the previous video, order blocks come in different shapes. They come in different sizes. Obviously we have a bigger order block with more candle, and then we have the smaller order block with more wick than candle. Now, basically in order blocks, the ideology of how they work and the theology of how they work is we want to see big moves in the market, right? We don't want to see a small little up candle or down candle and then a small move up. We want to see a nice order block created, and right after that order block is created, we want to see a major expansion move up. But a lot of the times people have problems. A lot of the problems that people have is that they don't know which order blocks they should be taking when there's multiple OBs all over the market. So I'll give you guys an example, right? Like just looking over here at this setup, from here you just be confused. You just be thinking like, okay, wait, like, do I take the OB here? Do I take the order block here? Do I take the order block here? Where do I take it? So this video is going to be covering all those things. So if you guys are here so far, I'm sure you guys would know the Fibonacci little cheat sheet that I did show you. But if you guys do not know that, then here I am to show you. So with order blocks, you want to basically highlight your expansion. You know, we have our expansion move up right here. We make this blue. Let's make this zone, make this a little nicer, boom. And then we have a retracement zone back down right here, and let's make that purple. So what we're trying to do is we're trying to catch that order block at the open of the expansion up. So this is the expansion up, right? So what I would do is I would take my fib from the low to the high of the expansion. Now any order blocks that are above the 61, 50, and 38, we don't take it at all. Any institutional candle that's in this blue zone, which is the 70%, the 78%, and the 88%, these are the institutional candles that we would be focusing on. Now I know that's pretty easy to say, like, okay, just take the OB that's inside here, but I'll show you guys some live examples of how you can actually use this and you know, in effect. So one thing that I want you guys to realize is that we're not trying to chase this trade. We actually want to see that retracement. We're trying to enter on the end of that retracement and catch that, once again, that major expansion move back up, and then once again price retraces. So in this case, when you see the market retrace and then you see another expansion move up, now same concept, you take your Fibonacci from the low up to the high, and you would want to focus on the institutional candles that are in the 88 percentile, 78 percentile, or the 70 percentile. And most of the times what you're going to end up seeing is price will generate liquidity before it comes to your area of interest. So let me just quickly move this over here, and towards the left you can see that we have money just chilling at the lows right here. That means this is a double bottom that retail traders are looking to capitalize on. And the third time price comes down, it takes out that money, and we know that if there's liquidity inside of our area of interest or liquidity above and below our areas of interest, that increases the probability of our institutional candle playing by a lot. So let's go to some live examples, right? Let's go to for example, right over here. So I'm gonna delete everything, right? I'll keep this, but I'll just delete all this stuff right here. Actually, fuck it, I'll just delete everything. All right, so basically we have our, you know, our chart. Now before we do get into order blocks, let's look at the trend. Trend is clearly up. We don't need to, you know, argue with the trend. We know obviously we're looking for buys because the trend is up. Now identifying liquidity, that's the first thing you should do after you understand what the trend is. Liquidity wise, we all know that there's a ton of liquidity just resting below here. We have tons and tons of money waiting to get picked up from here. Now I'm not going to make like a big zone because I like to keep my charts clean, but something like this, you know, if we were to draw a zone, it would look exactly like this right here. So we know that there's a bunch of money just resting below, and like I said, the market is basically attracted to wherever liquidity is. So if we use my strategy of using the expansion and then the retracement, right, make this blue, make this red for manipulation, because we know that's manipulation, and then once again let's make this blue, boom. So we have our two expansions. This is the first expansion, this is the manipulation, this is the second expansion. Now like I said, we're looking to catch that retracement into the start of that expansion and then buy, right? And the reason we say that is because, well, first thing first, let's take our fib, right, from the low of the expansion to the high. Why are we looking to enter on the 88, 78, or 70? Well, it's not because it's just random. We're we're looking to get in on these levels because these are discounted levels. Price action is going to respect these levels because it's cheaper for the banks to buy down here compared to buying up here. Because the banks also have to get in for good entries. It's not like they can just buy and sell wherever they want. They have objectives and rules that they themselves have to follow. So that's why the 70, 78, and 88 are institutional candles that are in those blue zones are much more higher probability. So technically speaking, this area right here would, it would be stronger. We would expect price to come into this area right here. But like I said, the market is attracted to liquidity. If we know that there's liquidity right below that area of interest, all this money that rests over here, we know that price is eventually going to have to make a run below that level to take out all that money. And that basically means that this area of interest that we'd be focusing on, let's go down to the 2 hour, let's go down to the 3 hour time frame and try to find an institutional candle. Perfect, right here. So institutional candle right over here, boom. We have this institutional candle, last down candle before the move up. It gave us that continuation of structure. We have a ton of momentum. We have everything that matches up, with our trend and rules-based system. It makes sense, correct? But one thing, the reason we would not be expecting to take this is, like I said, because there's liquidity. So if we look below the liquidity, what do we see? Well, we see the same exact thing. We have this area of expansion right here where the market pushed up. And then we have this area of manipulation where the market consolidated for a bit, or retraced, whatever you want to call it. And then we have this area where price re-expanded back up and gave us that continuation. So now you have to ask yourself this. If there's liquidity below this area right over here, and price has to go down over here, it has to take out that money. Let's look at this level. Is there any liquidity resting here? No, there's no liquidity. There's literally nothing here interesting about this expansion up here because there's no liquidity. There's liquidity right over here, and what's below here? Obviously our area of interest. So let's go down to the 2 hour time frame and let's look for that last institutional down candle or up candle before the move up. And in this case, we have it right here. We have our last institutional down candle. Sorry about that. Yeah, so we have our last institutional down candle before the move up. Now let's investigate this. Like I said, an institutional candle should break highs. It should create new highs. For example, right over here, we have on GJ a current high. This move up broke that current high with a newer high. So it gave us that continuation of structure. So at that point, I could highlight this and say, okay, this is my COS top. So we have our continuation of structure. Now, that's why we would be focusing on this institutional candle rather than this one, because one, there's liquidity below here. Even though the setup will look really clean, it makes sense to be focusing on it. The setup looks clean, but it's all about where the liquidity lies and what our rules say. There's liquidity below here, and that means that the market is going to have to make a run below there and come into here for about like 320 pips, right? Make a nice deep drop. Now, if we go down and look at structure-wise, we can clearly see micro-wise, the structure is also pretty bearish. We have a high, we have a low. Sorry, we have a high, we have a low. Lower high, lower low. Lower high, and we haven't made that lower low quite yet, but we're going to make that lower low. Now look at this. If price was right over here, right, one thing people would start doing is they would be like, okay, wait, like we have an institutional candle right over here, like it looks like a good time to buy. Well, you're completely ignoring microstructure. The microstructure is completely bearish right now. If the microstructure is bearish, then the market's going to continue going lower. We don't have any proper opportunities to buy right now. Even though this order block does look clean, it did push up, but you still have to look at the higher time frames and identify and map out where your liquidity is. And yeah, that's basically what you have to do. You have to map out where the liquidity is, because basically the charts are telling you a story, and you have to read that story. It's like a puzzle that you have to slowly compile and put together. So this puzzle, that what the market is telling me is this does look like a good level to buy at, right? Because we can't just buy over here because there's an order block. Because look at how high price is. It doesn't look high when you go down to the 15-minute time frame, but this is why I say don't go to the 15. But look how high it is, right? We have an institutional candle here. It broke structure towards the left. You would think it's a good time to buy, and then you look at the left on the higher time frames, and you see all this noise over here. And we're gonna get into imbalances soon. Actually, I think you guys should have already watched that video, but yeah. So basically, yeah, that's basically The banks are, it's just telling you a story, and you have to put that puzzle together and understand that story. So we know that the market is gonna have to take out liquidity. Now, what's not interesting me about this area right over here is that price action didn't do much here. It did give us that impulsive move up, but there's no reason for why price needs to come back down. Yes, there is an institutional candle right here and over here, but this isn't interesting because there's no liquidity over here. You have to ask yourself, why do the banks want to push price down? Because this, as this does look really nice and pleasing, we can't trade the markets by what's pleasing. We have to trade it by what's logical. Why would the banks sell all the way back down? Have they done that in a long time? No. They've been making deep retracements, yes, for about, what's that, like 400 pips, and this one was also about 400 pips. So why would the market not make another 400 pip move? Why would you expect it to make another 700 pip move instead? Obviously, we're expecting a 400 pip move. It's creating deep retracements, but why is it coming to this level over here? And why isn't it coming all the way back down to over here? Well, that's because the banks don't have a reason to push price down there. But let's stick to the topic. So we have our Fibonacci retracement. Let's measure the high or the low to the high. Now, boom. Let's go down to the 1 hour, or let's go down to the 3 hour. Let's look at price. So we have our institutional candles in the 88, the 78, and the 70. Now in the 88, we have a really, really clean institutional last down candle before the major move up. Let's go down to the 2 hour time frame and see if we have more. On the 2 hour, we don't have any more. We still have this last institutional down candle before the move up. Let's go down to the 1 hour. Same exact thing. Now we do have one in the 70% right over here. So this is also a potential area of interest you could be focusing on right here. You could have your area of interest right here. So now you have two levels of interest. And then you go down to the 45, and basically that's it. There is one more below the 88, and that's fine. If it's below the 88, it's fine, as long as it's not below the 100. So now we have 3 points of interest, but the one that makes the most sense is the 88 percentile one, right? And this is because this is the last actual down candle before the major move up. Look at the volume in this candle. There's a ton of volume and momentum, and it gave us that continuation of structure. So our areas of focus would, most probably be these two levels, this one and this one. Now let's go to gold. Let's actually go to gold right over here, and let's look at the different types of institutional candles that we're gonna see in the market. So right here on gold, the way I caught this buy is really simple. Obviously, gold was selling off a ton. There was no wyckoff, or there was no bullish market structure. Everything was showing that the price wants to go down. Now price randomly just rallies up, and we haven't done that in a while. And not only that, but we broke structure because we had this lower low, lower high phase in the market. We end up breaking structure, and like I said, the level, that expansion move that broke structure, what we want to do now is we want to focus on it. We want to focus on the start of that expansion. So let's go back in time just over here. Let's go down to the 15-minute. Now on the 15-minute time frame wise, where is our last institutional down candle before the move up? Clearly our institutional candle is this one right here. Now you could be focusing on this one over here as well. This one makes sense. But the reason I was focusing on this one instead of this one is because, like I said before, liquidity. Look at those equal lows that just chilled right over here. There's money resting below here. And below that we have our institutional candle right over here. And there's two ways of marking up your IC. You can either do it from the open to the low and put your stop loss right here, or you can put it to the wick low to be a little bit more safer. Now let's go down to the 1 hour time frame again, and yeah, let's just analyze structure at this point. So at this point, you could take your fib and measure from this low up to this high, but you don't know if this is where price is gonna stop becoming bullish. You don't know that. But in this case, it didn't. You can see it continue going up. So what we have to do is we have to wait for the consolidation phase to come in before we start focusing on other things. But in this case, the market retraces and then re-expands back up. So what you would do in this case is you would focus on this area now. Now you have two areas of focus. Your second expansion, and then your first expansion right here. Expansion, retracement, expansion. What do? Well, same thing. Focus on that last institutional down candle before the move up. Now, this is an amazing example of where it did not work out. I'm not going to lie to you, say this is the holy grail. It isn't. But this does work out, but most of the times it will work out. But there will be some times where it won't. But that doesn't necessarily mean that you just completely quit. This is where risk management comes in. So price ends up breaking down. So now we can highlight our low up to the high right here. And as you can see, our area of focus is below the 88. We have the 78 and then we have the 70. So in the 78 and 88, we also have this institutional candle that we could focus on. So either way, we have the Fibonacci confirmation now. We have a order block inside the 88 percentile confirmation. So at this point, what we do is we would simply just wait for price action to come back into our zone. Now, what do you see happening right now? Price is creating liquidity. We have this little bull flag pattern. Now this means that the market is going to have to tank deeply. Why does it mean why deeply? Well, because there's money here, 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 here. That means there's stop losses all over the market. Now someone might say, okay, wait, is this my expansion right here? No, this is not your expansion. Let me tell you why. This expansion needs to break the previous high. It did not break the previous high, so it's basically just consolidation. It's nothing. We need to see that. Now we have that major expansion that broke the high. So technically speaking, you could focus on this area of interest, or you could focus on this area of interest, because this is your expansion and so is this, right? Now let's play this out. And in this case, price did not respect it. Completely fine. I'm not here, remember, I'm not here to lie to you or nothing. I'm here to be completely 100%. This strategy that I'm showing you, it works, but you also have to create rules of risk management, because even though we did lose 2%, that's only 2% to make a potential, you know, whatever 15-30%. But now that we did lose that, now we can see why price didn't respect that, because there's liquidity now. The market generated liquidity and price has to come back down to take out all those lows. So to go down to the 4-hour time frame, and simply let's focus on two levels. We have our first level of expansion right here, and then we have our second level of expansion right here. Now one will give you a small intraday move up, the second one will give you that major move that you're looking for. Boom. Price ends up breaking out the liquidity, did not respect this level. It did respect it for a little bit, for about 80 pips, 90 pips, which is decent. You did get an 80-90 pip move out of that, but that is a small intraday move. But you can see price ends up retracing down to take out the liquidity of the lows, and then it comes back into our original area of expansion. And where did it go back into? Well, it came back into our last institutional down candle before the move up that we marked on the 15-minute. If we go down to the 15-minute right now, and we try to understand micro versus macro structure and use that as a confirmation, it's simple. We have a low, lower high, low, lower high, lower, sorry, low, lower high, low, lower high, lower low, right? We have this lower low right here. Now price ends up breaking above that. So we have a break of structure of the highs, and then the market continues to go up. It just continues to go up. So once we get that break of structure, what are we doing? Well, we're highlighting our expansion, and we're taking the fib from the low up to the high of wherever the expansion finished. And we're looking for institutional candles inside of the 70%, 70, 78, or 88. In this case, price barely missed it. If we go down to the 5-minute, if it lets me, yes it does. We did have a really clean institutional candle right over here. Now, if we took it from this into the last institutional down candle, we would have missed it just by 40, what's that, 41 pips, sorry, 4 pips. We would have missed it just by 3.7 pips, which it sucks to say, but that will happen at the end of the day. That will happen a lot of the times. But I'm just here to show you that this way of trading does work. Sometimes you will end up missing out on trade opportunities, but it does work. Now, if you do see something like this, where you see your institutional candles in the 70, but there is another candle right above it, what you could do is you could highlight both of it. You can highlight both candles. That way, you do get filled in. So as long as there's an institutional candle and there's another candle right beside it, you can highlight both of them, and that's something I do a lot. If we go down to the 6-minute, I think, or 7-minute, there we go. So on the 7-minute time frame wise, you would have got filled in, right? You would have just got filled in, or maybe spread would have missed you. I don't know if you're accounting for spread or not, but you would have just got filled in, and this institutional candle is in our 70. So with order blocks, generally every single order block on time frames work. There's the 7-minute I use, the 15-minute, the 5-minute, but that's only when price is in a higher time frame OB. For example, let's say I have my higher time frame 4H POI. Let's say this is my 4H POI, price moved out of once. The next time price comes into this level, my point of interest, at this point I would go down to the 5-minute, the 15-minute, whatever minute, 7-minute, 6-minute, and I would look for microstructure to go bullish. And once microstructure is finally bullish, I would highlight my expansion. And then from here, I would go on the 5-minute, 6-minute, 7-minute. I take my Fibonacci, I will highlight the low to the high. and I would simply look for institutional candles inside of that range of 70, 78 or 88. And if I do see that institutional candle, I would set a limit there, and most likely price would continue its bullish rally towards the upside. And the gold example that I just showed you is a perfect example right here. Now let's go down to the 4-hour time frame, and let's look at what else the gold did. So right here we have a impulsive move up after a consolidation, right? So we have that. Now what you'll see sometimes is this looks like a really nice institutional candle. You know, it's nice. It had that major move up that broke structure. It's good. Now we would be focusing on it, but look what happens. Price ends up consolidating inside of this area, and then the market doesn't, you know, go down. It just makes a new high. It breaks a new high. If you do see something like that happen, just remember that this area of interest is now more of a longer time frame thing. It's more of a long-term area of interest that you would want to focus on, maybe in the next few weeks or months. But now you have to switch your focus, your area of interest, from this into the next expansion. So if the expansion before, if the manipulation occurs, for example, right here, and then a newer expansion happens without testing your area of interest, you have to switch your expansion, or you have to switch your area of interest to the next expansion. In this case, price expands up, retraces, you know, manipulates, and then expands once again. And then we didn't get the opportunity because price didn't come back down to retest this area of interest right here. Now, one thing you could definitely do is understand market structure on the 15-minute time frame wise, on micro time frame wise, inside of the manipulation. Right here in the manipulation, what do we see? We have a low, we have a high, we have a lower low, we have a lower high, lower low. We do have a higher high, but then we're followed with another lower low. So overall structure on this 15-minute time frame inside of this manipulation phase, it's 125% bearish. If you don't understand that, just do this. Now you can see that price is moving in a downward direction. Now as soon as price came right over here, what did it do? It went up and broke significant microstructure. What does that mean? Like I said, if the 15-minute time frame is breaking microstructure, then that means that the macrostructure, and the macrostructure is bullish, and the microstructure is slowly breaking previous bearish structure and switching to bullish. That means that both time frames correlate with each other, and they're getting ready to give you a big push up. And what did I do in this situation? Well, let's zoom in. I looked for that last institutional down candle before the major move up. Now, it did not look like that from there. Let's go down to the 45, and this is what it looked like. On the 45-minute, this is that last institutional down candle before the major move up. Now, someone might say, what about this one? What about this one? What about this one? I went with the one that looked the cleanest. These, they didn't look clean at all. I want to see a big move up. That's it. I don't want to see no consolidation, no choppiness. I want to see that nice down candle and then that nice move up. And if you take your Fibonacci from the low of the expansion up to the high, you can see that it's also in our 88th percentile. And what ended up happening is price came perfectly inside of our expansion, or inside of our manipulation area. We went down to the 15-minute time frame, and we started analyzing structure. Or I think it was on the 5-minute, sorry. So 5-minute time frame wise, what do we see? We do see that price is overall moving bearish, but what we needed to see was price action start moving bullish. So what we needed to see was obviously some structure break. Now I can't go to the 1 minute, I think the trading view won't let me, but on the 1 minute time frame there's a really clean lower high right over here. Now we ended up breaking past that lower high with this move right here. So at that point I said, bet, let me set a limit at my overall area of where price started its expansion. I think I can go to the 3 minute. Yeah, I can't go to the 1 minute, but it will definitely let me go to the 3 minute. And right, okay, yeah, so I can go to the 1 minute, but in the 1 minute time frame, there was a clean institutional down candle before the major move up, and at that point, I waited for price to come back into that original area where price expanded and broke structure, set my limit, and then price triggered me in. So this is where you basically have to just understand structure. You can't just set your limit over here and wait for price to come. You could do that. I do that a lot of the times as well. It's really easy. It's chill. You just set your limits and wait for price to come. But it's better that you look at structure when price is manipulating, so you don't miss this major move up. And that's why I caught this. Now once again, price expands, manipulates, comes back up. Did not make a deep retracement back down. Now right over here, this is where things got a little bit crazy. So the market manipulated, it went back down to take out the liquidity of the lows. Now, and like I said, we're not taking institutional candles that are not inside of our 70, 78, or 88. So we wouldn't have taken this institutional candle over here. But price breaks down to take out the money, all that liquidity, and then it breaks above. Now, this is where things get interesting. If an order block is in the form of sweeping liquidity, that order block becomes a million times stronger, a million and trillion times stronger. For example, this move down, we see this move down right here. Price ends up taking the liquidity of the lows. We take liquidity of the lows, and then we have this clean institutional candle that swept that liquidity. This entire move swept liquidity, and this is that last institutional down candle before the major move up that took the liquidity. Now we broke structure as well. Now after we broke structure, there's a ton of momentum. And price didn't come back to retrace it. It did not come back to retest it right away. And like I said, you have to move on. That's completely fine. But remember this area for the longer term, for later on. And what ended up happening? I'll get into this area right here later on. But price ended up selling off to do what? To take out the money of the lows right over here. Retested this area of liquidity, this area of institutional candle that swept liquidity perfectly. And then from there, the market created its major move up, stop loss at the low, TP at the next high. That's what the market ended up doing. Now, you don't need to target the next high. You could easily just target the next OB if you want. But I'm trying to show you guys that this isn't just a coincidence. This is just how the market moves. It's all about liquidity. Think about it. The reason the market made this major move down over here is because all the money that rested over here. Look at this 1 touch, 2 touch, 3 touch, 4 touches of support. That means there's money resting below that the market has to take out. But anyways, so before that happened, after this manipulation, we have the second re-expansion up. Now, what I did is I highlighted my expansion from the low up to the high, and we have the 70, 78, and the 88. Now, in this point, I went for the cleanest institutional candle that I could find. I found the one that was in the middle, which was the 78, which was this institutional candle, and I was not only focusing on this one, but I was also focusing on this one as well. So I had two potential levels of interest, 1 and 2. The first one, I set a limit right away, and let me tell you why. The market created liquidity right below my area of interest. Like I said, if the market is creating liquidity right below your area of interest, this is a strong confirmation that the market will respect it. And that's what ended up happening. Price respected my last down candle before the move up, tapped into 1884 to the dot perfectly, and then from there we targeted the next high, and price did its thing. Now, why did price end up selling off all the way back down to here? Well, think about it. Once price did come back and tapped us into our institutional candle, it didn't really give you another major expansion back up. As it did give you this as your expansion, technically speaking, this is your expansion because it did break the new high. And you actually did catch that. You could have caught a really nice intraday move right here off of the open, but it didn't give you that biggest push up that you were expecting. Instead, the market ended up tanking. So that happened because of the liquidity that rested at the lows, and that's how important liquidity really is. So make sure that you guys remember how important liquidity is, that you're not just entering randomly at the highs, for example, like right over here. Like you're not just entering right over here or right over here because you see an institutional candle. You have to be timing your entries and being patient. If the institutions and banks aren't trading 24/7, why should you be trading 24/7? That's how our mindset should be. If the banks and institutions and market makers, they're barely entering the market. They're entering when they see opportunities to enter. They're not entering randomly just because they want to make money. They're entering because they have a reason to enter, and that's how our mindset should be as well. Now I'll go over AUD USD for this trade entry that I am waiting on. We'll get into Wyckoff later on, so you don't need to worry about that. But basically, market pushes down, consolidates. Once it did consolidate, this is where the market ended up reversing. And what did it do? It broke structure towards the left. We have a low, lower high, lower low, lower high, lower low, lower high, lower low. Price consolidates and moves up, and what does it do? It breaks this previous major lower high in the form and makes a new higher high. So what we're going to be doing now is we're going to be focusing on that area of interest that was responsible for that major move up. Now someone might say, okay, wait, track effects. You said that focus on the expansion, so I'm going to be focusing on this level and this level right here. That's true. I said focus on the expansion, and look what ends up happening. You would have caught that really clean intraday opportunity, right? You would have caught a really nice intraday opportunity. But this is where you have to manage your trade and look at what's happening. Once it already got tested, it got tested a second time and then a third time. So that means that there's this area is generally becoming a level of liquidity now. You have to keep your mind open to these things. If price did want to use this level, it would have just completely shot up. But it did use this level for about 100 pips, and then it ended up consolidating and creating money. So what does that mean? Well, that means that we have to focus on our second level of interest, right? And if we go down to the 1 hour time frame, or sorry, not the 1 hour, let's go to the 45, I think it was. I refined this a lot. We're going to get into refining entries in the next video. But boom, on the 30-minute time frame, we have this last institutional down candle in the form of sweeping liquidity. We have these equal lows, 1, 2. The market created this double bottom. Liquidity below, the market sweeps that liquidity in the form of an order block, and then from there, price creates its major impulsive move up. So initially, what we're waiting for now is we're waiting for price to clear all that money right over here, to take out all that liquidity over here, and then tap into our area of interest and then go up. So that's how simple it really is, just focusing on the expansion. Now let's go to GBP USD, and let me show you how easy it is to analyze this. Go to a brand new chart, delete this. I think I went over this already in a different video, but either way, let's do this. Like I said, we're focusing on the expansion. One expansion right here, second expansion right over here. We have 2 areas of expansion. Just to make this a little cleaner, I'll do it from here. Boom. Market expands, retraces, re-expands. Now, take your fib, low to the high. Technically, this is the high. And focus on the institutional candles that are inside of your, technically the expansion started from here, my bad. Yeah, so focus on the institutional candles that are inside of the 88, 76, 78, or 70. We'll go down to the 1 hour time frame. 1 hour time frame wise, what do we see? Well, we have an institutional candle right over here, last down candle before the major move up, and then we have an institutional candle right here. Now we also have one down here, but this is so ugly, it's choppy, it's too wicky, there's no clean candles. So I'm not going to be focusing on this. I'm going to focus on the cleanest ones. In this case, it's going to be this one and this one. At this point, all I'm doing now is I'm waiting for price to either come into this level or this level. I'll look for confirmation on the smaller time frames when price does finally do that. And when it does do that, if I see confirmation to enter, I'll enter. And if I don't, I don't, right? And then we also have our second area. Now, we also have liquidity right over here. There's a ton of liquidity over here. Liquidity cleared at the lows. We have a Tesla support, another Tesla support. That means that there's liquidity below our areas of interest. So you could set a limit right over here at the open, safe stop loss at the low right away. Now, this is a pretty premature entry, but you're risking 12 pips at the end of the day. So you could set a limit without waiting for confirmation, right? Set a limit here, stop loss at the low. That could work out, but I don't recommend that. I recommend everyone to always wait for confirmation. Now, same thing right here. Set a limit here and set a limit right over here. One of these 2 levels will play out. As long as you're risking 1%, you will be good at the end of the day. Now, same thing with the next one. Take your fib from the low all the way up to wherever the high was, which would be right over here. And where should your area of focus be? Well, let's go down to the 4 hour time frame. Let's look for our institutional candles. Let's go down to the 8 hour time frame. And on the 8 hour time frame, we don't see anything clean. 12 hour wise, boom, we don't see anything clean, but we do see this institutional last down candle before the major move up. And like I said, if there's more wick than body, then we're going to take the entirety of the wick to wick. In this case, there's way more wick than body. So from here, we go down to the 4 hour time frame, and this is our area of interest. Now, someone might say, okay, this is way too big. 88 pips, that's insane. Like, that's way too big. I'm going to get into the video for refining entries, but if you go down to the 3 hour time frame, you can refine your area of interest down to this institutional candle instead. So now you have 3 areas of focus. 1, 2, and 3. Most likely, in just off of my experience, I would assume price would come back down to this one instead of that one over here. Either way, they're really close to each other. So yeah, so now we have 2 areas of focus that price could come down to. How did I find this? It's really simple. Expansion, retracement, expansion. The institutional candle that's at the low of the expansion is the most important. That's my own, like, I guess, thing. I've never seen someone on YouTube use this type of strategy or use this type of understanding of the markets. People overcomplicate it way too much. But that's basically the different types of order blocks, which ones you should be using and which ones you shouldn't. And by the way, don't go for order blocks that go against the trend. We'll get into the scalping video real soon, but for now, don't do that. It's way too risky. I'll show you guys an example where you could use an order block that goes against the trend. So we have this higher high, higher low trend, right? We create that higher low, create that higher high. Now we end up breaking past it. Look, we end up breaking past it. We created a break of structure of this previous higher low, BOS bottom. Now at this point, you could focus on the open of the institutional candle that was responsible for that break of structure. In this case, it would be right over here. You could have your area of focus right over here. This is that last up candle before the major move down that broke structure. Now we also have imbalance. We'll get into that in the second video. But yeah, that's basically the only times you could focus on institutional candles that go against the trend. But even then, it gets really risky, specifically because the probability of price randomly selling off is not higher than price randomly going up. Because if the trend is up, most likely there's more probability of price going up. I'll give you guys an example. If you're in a soccer game and a team, you're playing against a team, they won all the cups, they won all the trophies, they have all the goals. They've never lost a game. What's the probability of a team that is mediocre, has some wins, some losses, winning against a team that's never lost? Obviously, the probability is lower. The probability is going to be with the team that's won every single one of their games. That's the same concept. If the trend is overall up, even though you see that break of structure, the probability is still lower of price using this to go down. Even though we have reasons for why we want to see price come down, it's still risky, and that's why I say trade with the trend. But if you're going to trade against the trend, make sure that the structure is with you. A structure as in you see that break of structure, and 2, risk management. But that's basically the video on different types of order blocks and how to understand these order blocks and find these levels of interest. But thank you guys for watching, and I'll see you guys in the next one. Peace.